and Pharmaceuticals in association with Higher Secondary Principals Forum.
Hi everyone, I am Mr. Mallikarjun Hoogar, a teacher in Accountancy from Konkani United Higher Secondary School, Salsette, Goa. Students, you already studied the various aspects of partnership, that is formation of partnership firm, how to form the partnership firm and how the accounts are to be maintained, then how to reconstitute the partnership form like admission of a partner, retirement of a partner and death of a partner. The last topic in your syllabus is dissolution of a partnership firm. Okay, we are going to discuss about the dissolution of a partnership firm. What is dissolution? Dissolution means breaking up of or extinction of existing relationship among the partners. Under the Indian Partnership Act of 1932, the dissolution may be either of partnership or of a partnership firm. Now, dissolution of partnership is different from dissolution of partnership firm. Then what is dissolution of partnership? Dissolution of partnership refers to the change in the existing relationship between the partners, but the firm may continue its business as before. On the other hand, dissolution of partnership firm means business of a firm is closed and the firm comes to an end. Now, dissolution of a partnership is the change in relationship of the partners. It may occur on account of change in their profit sharing ratio, admission of a partner, retirement of a partner or death of a partner. Here the business is not going to come to an end, only there will be change in the partnership agreement. On the other hand, the dissolution of a partnership firm means here the business comes to an end. The business will be totally closed down. Now let us see what is the difference between the dissolution of partnership and dissolution of partnership firm. On the basis of termination of business, we can distinguish between dissolution of partnership and dissolution of partnership firm. In case of dissolution of partnership firm, the business is not terminated, whereas in case of dissolution of partnership firm, the business of the firm is terminated or it is closed. Now coming to the second point of difference, on the basis of economic relationship, we can distinguish between dissolution of partnership and dissolution of partnership firm. In case of dissolution of partnership, the economic relationship between the partners continues, though in a changed form. Economic relationship means here it is a working relationship. So partners are going to separate. Okay, they don't continue with the business. Whereas, in case of the dissolution of partnership, the economic relationship between the partners continues, but in a different form. Whereas in case of dissolution of partnership form, the economic relationship between the partners comes to an end. The business will be totally stopped. Now, the third point of difference is court intervention. Means sometime there is a interference from the court. In case of dissolution of partnership form, there is no intervention of court, whereas in case of dissolution of partnership form, the court intervenes if deemed necessary. Then, coming to the fourth point of difference, books of accounts. Books of accounts need not be closed in case of dissolution of partnership form, whereas in case of dissolution of partnership form, we have to close all the books of accounts. Then settlement of accounts. In case of the dissolution of partnership form, the assets are revalued, assets as well as liabilities are revalued or reassessed, and profit or loss on revaluation is distributed among the partners. As far as dissolution of partnership form is concerned, assets are realized and liabilities are paid off, and the balance, if any, is paid to partners to settle their accounts. So this is what the difference between the dissolution of partnership and dissolution of partnership form. Now, what are the modes of dissolution, that is methods of dissolution? As far as the modes of dissolution is concerned, we can divide into two parts. One is dissolution without the intervention of court, and the second mode is dissolution with the intervention of court. Now, dissolution without intervention of court. Under what circumstances, under what situation the firm will be closed without the intervention of court? The first reason for that is dissolution by agreement. This is as per section 40 of the Indian Partnership Act of 1932. Whenever the partners wish to close down the firm due to one or the another reason, they can close it with mutual understanding or mutual agreement. So this is the one reason, or circumstances under which the partnership firm will be closed without the intervention of the court. Coming to the second reason, compulsory dissolution. Compulsory dissolution means, suppose if partner becomes insane, or is declared insolvent, under such circumstances the firm has to be closed down. Coming to the third one, dissolution on the happening of certain events. Now, due to certain circumstances or situation, partners are forced to close down their partnership firm. One is on the expiry of the period. As you all know, we have a partnership firm, formed for a specified period. On the expiry of the period, the partnership firm will be closed down. The another situation is completion of the venture. Venture means a business. Suppose if a particular partnership firm is formed to undertake a particular activity or to achieve a particular objective, once the objective is achieved or the activity is completed, then they have to close down the business. Moving to the next one, death of a partner. Suppose if any partners dies, under such circumstances, the partners have to close down the partnership business. And the other one is insolvency of a partner. Insolvency means insolvent is one whose liabilities are more than assets. So he won't be able to pay all his dues. So such partners are called insolvent partners. Due to insolvency of a partner, the firm will also be closed down. This is as per section 42 of the Indian Partnership Act of 1932. Now coming to the next one, dissolution by notice. As per section 43 of the Indian Partnership Act of 1932, a particular partner can serve the notice asking all other partners to close down the business. So these are the situations or circumstances under which the partnership firm will be closed down without the intervention of the court. Now coming to the other mode of dissolution, that is as per section 44 of the Indian Partnership Act of 1932, court is forced to intervene for the dissolution of partnership firm. Under what circumstances court will ask the partners to close down their business? One is on account of insanity of the partners. If partners becomes insane means it is a person with unsound mind. Okay? So under such circumstances, the court can ask those people to close down their partnership firm. Moving to the next reason for that is permanent incapacity. Permanent incapacity means suppose if some unwanted incident happens, suppose a partner meet with an accident or is affected by some diseases and all. So because of that, he is not capable of carrying out his day-to-day activities. Under such circumstances, court can ask them to close down. Then misconduct. Suppose if any partner or partners violate the provisions of the Indian Partnership Act of 1932, under such situation also the court can ask the particular partnership firm to close down the business. Then persistent disregard of partnership agreement by a partner. Suppose if any partner violates the provisions or he acts against the interest of the partnership firm, okay, or he or she may engage herself or himself in the activity which is competing with the main activity for which this particular partnership firm is formed. So under such circumstances also the court will ask them to close down the partnership business. Then continuous loss. Suppose if the court feels that there are no chances of revival for this partnership firm, okay, if the loss continues year after year, under such circumstances also the court can ask them to close down. Then the last situation under which the court can ask the firm to close down the business is transfer of interest. If any partner transfer their entire interest to the third party, under such circumstances also the partnership firm will be closed down. So these are the circumstances or situations under which a partnership firm will be closed down. When the partnership form is closed because of one or the another reason, we have to settle the books of accounts. We just cannot pull down the shutter of the business, you can quit the place. What you have to do is, whatever the assets are there, all those assets are to be disposed of, and with that money you have to settle all the liabilities. Okay? So this is what you have to do on dissolution of a partnership firm. When you sell the assets, you are going to get the money. That money should be used to discharge the liabilities. Then how to go about this? From the total amount realized, first of all, you have to use that money to pay firm's debt to the third parties. Third party means that is the outsiders. Okay? You have to pay those liabilities. After paying the third parties, if there is surplus money, then that money should be used to pay loan from the partners. Then after paying this loan, still if there is extra money, that money should be used to pay back the capitals of the partners. And still if there is more amount left with the organization, that money should be used, okay, to distribute among all the partners in their profit sharing ratio. So this is how you have to settle the books of accounts. Okay, now we will see the proceedings of dissolution. Whatever could be the reason for dissolution of partnership firm, we have to settle the accounts of the firm. In settling the accounts of the firm after dissolution, the following accounts are opened. The first one is realization account, partners capital account, and cash or bank account. Now, realization account is opened for disposing of all the assets of the firm and making payments to all the debts of the third parties. So the account prepared to dispose of all the assets of the firm and make the payment of all the debts of the third party is known as realization account. Realization account is a nominal account. The objective of preparing the realization account is to find the profit or loss on realization of assets and payment of liabilities. The balance, whatever the balance remains in the realization account, that could be either profit or loss. The profit or loss on realization is transferred to partners' capital accounts in their profit sharing ratio. Now, how to prepare this realization account? To prepare the realization account, the following steps are taken. First step, transfer all assets, that is, except cash and bank balance, debit balance of partners' capital accounts, and fictitious assets to the debit side of realization account at their book values. So, to transfer the assets, you have to take certain precautions certain points should be kept in mind. What are those? The first point to consider is transfer only realizable assets. Realizable asset means the assets which can be sold and you can recover the money on dispose of those assets. So, those assets are called realizable assets. As you all know, in balance sheet we come across different type of assets like tangible assets, tangible fixed asset, intangible fixed asset, current assets, then cash or bank balance, then you will get this fictitious asset like preliminary expenses, advertisement expenses, partners account, that is debit balance. So, these are the items normally we come across on the asset side of the balance sheet, but while transferring the assets to realization account, you have to consider only the asset which can be realized or the asset which can be disposed of. And the second point which you have to consider is transfer only recorded assets. Recorded assets means the assets appearing in the balance sheet, not in the adjustment. Then the third point which you have to consider is transfer assets at their gross values. Gross values means the value before making adjustment. You know, there are certain assets called valuation assets or contra assets or assets with link. For example, plant and machinery, and below that you write provision for depreciation, or debtors, and from debtors we minus provision for doubtful debts. So, after minusing the provision for doubtful debts, you get to the outer column, okay, that is called net value, and the value before you minus the provision, that is called gross value. So, wherever there is an adjustment, provision for assets, those assets are to be transferred at their gross value but not net value. As far as fictitious assets like advertisement, suspense account, profit and loss account, debit balance are to be transferred to partners capital account, not to the realization account. And cash and bank balance is not to be transferred to realization account, as cash is already in the liquid form. So, we are not going to dispose of cash. Okay? So, that is the reason why we should not transfer cash or bank balance. That cash or bank balance goes directly to your cash or bank account. For example, let us see the balance sheet. On the asset side, we have assets like land and building, plant and machinery, investments, stock, debtors in the inner column 1,45,000, less reserve for bad and doubtful debt 5,000, outer column it is written 1,50,000, profit and loss account, deferred revenue expenses and cash balance. So, I said you have to transfer only realizable assets. What are the assets that can be realized? Land and building can be sold. We can recover money on sale of land and building. You can sell plant and machinery, you can recover the money. Investment you can sell, you can get the money. Stock you can dispose of, you can get the money. You can collect the money from the debtors. So, these all are realizable assets. All these assets are to be transferred to realization account. Why to transfer this asset to realization account? When the firm is closed, you have to close the assets account also. Now, say for example, land and building. When you acquire the land and building, we are going to open land and building account in the ledger account. If you are closing the firm, you have to close the land and building account. You all know all assets have debit balance. You can see in the example, your land and building is an asset, it is having a debit balance of rupees 5 lakh. Now, since the firm is closed down, you have to close this land and building account. We close it by transferring to realization account. So, what we do, only on the debit side there is a balance of rupees 5 lakh. Okay, remove this total, get it to the credit side, that is 5 lakh. Okay, the same, now you have to make this amount 0. To make this amount 0, you have to put 5 lakh. So, this we are going to transfer to the realization account. So, we have to close this land and building account by transferring to realization account. When you transfer to realization account, the journal entry will be realization account debit to land and building account. Same way, your debtors account, debtors is also having debit balance. So, on debit side it is 2 balance brought down. We close it by transferring to realization account. So, the entry will be realization account debit to debtors account. Whereas, the RDD is a liability provision. All provisions have credit balance. So, the RDD is having credit balance. So, to close it, we have to debit the RDD account, credit the realization account. So, when you transfer, they comes in the realization account on debit side as to sundry assets account. So, land and building rupees 5 lakh, plant and machinery 3 lakh, investment 1 lakh, stock 50,000, debtors you have to take it gross value, that is before minusing your provision for bad and doubtful debts. So, the total should be brought into the outer column. I told you that debtors you have to take it the gross figure, and that RDD should be credited to your realization account. It appears as by reserve for doubtful debt account rupees 5,000. So, this is the first step in preparation of your realization account. Then the second step is transfer of liabilities except general reserve or other reserves, profit and loss account, credit balance, partners capital, partners loan to the credit side of realization account. For transferring liabilities to the realization account, also you have to keep certain points in mind. Those points are: transfer only the external liabilities, transfer only external liabilities, transfer liabilities at gross figure, and transfer only recorded liabilities. Now, recorded liability means the liabilities appearing in the balance sheet on the liability side. Okay, unrecorded liabilities normally are shown in the adjustment. But the care should be taken while transferring the liabilities. Okay, you don't transfer partners capital, okay, to the realization account. The partners capital account is to be transferred to partners capital account on the credit side. Reserves, accumulated profit or any other reserves are to be transferred to partners capital account on the credit side. So, this is how you have to transfer the liabilities, that is external liabilities, to the realization account to close their books of accounts. For example, as you can see from this balance sheet, on the liability side, we have items like capital accounts, this is internal liabilities, general reserve, this is also internal liabilities, Amit's loan, Amit is a partner, so this is also internal liabilities. Mrs. Alex loan, Alex is partner, the loan is not from Mr. Alex, it is from his Mrs. So, Alex is a partner, his Mrs. is not a partner, so it becomes a outside liability or external liabilities. So, this is external liability, sundry creditors also external liabilities, bills payable also external liabilities. So, while transferring the liabilities, you have to transfer only the external liabilities. So, for example, sundry creditors, all liabilities have credit balance. So, in the creditors account you will find the balance on the credit side as rupees 3 lakh. Now, this sundry creditors account is to be closed. So, to close this you have to take the total, whatever the total is there on the credit side, bring it to the debit side. This balance to close means it has to become 0. So, you have tried 3 lakh and close it by transferring to realization account. So, the entry for this will be sundry creditors account debit to realization account. So, these items goes to your realization account on the credit side. As you can see from this realization account, by sundry liabilities, that is Mrs. Alex loan, sundry creditors, bills payable. So, these are written here. That Amit's loan, it is a partner's loan, that should be shown in a separate account called Amit's loan account, because after paying the external liabilities you have to pay for the Amit's loan account. So, that payment can be done directly through this loan account, and by making the payment to Amit you can close the books of account. So, this is how you have to transfer all the liabilities, external liabilities to realization account to close the books of accounts. Now, coming to the third step, make entry for the assets realized. We already closed the assets account and liabilities account. Now, we have to start with recovering the money. So, realization is nothing but it is a recovery account. Okay. Now, credit the amount of assets realized to the realization account. For crediting the amount of assets realized to the realization account, the following points should be kept in mind. The first point is, here we should not bother about what was the book value and what amount is realized and all. Whatever the actual money you collect, that money should be taken into account. So, consider the actual amount received. Whatever your land and building may be 10 lakh, even if you sell for 5,000, just you have to take 5,000, don't bother about the difference amount. Then, second one is, suppose in the problem, okay, if there is no specific information or in the absence of any information regarding realization of intangible fixed assets and current assets, it should be assumed that no amount has been realized from such assets. If they are tangible fixed assets, okay, if nothing is given in the problem, you have to assume that those assets are realized at their book value. So, this is what you have to keep in mind while making entry for the amount realized. Now, sometime a partner or partners may agree to take over the assets. That is also realization only, but only thing is we are not getting the money, but the asset taken over by partner is debited to partner's capital account, means finally debited to partner's capital account, credited to realization account, means to that extent the firm's liability towards the partner decreases. So, it becomes as good as sale recovery only. So, if any partner take over any asset or assets, that should be credited to your realization accounts. So, this is what the third step, that is for making entry in the realization account for the assets realized or the money recovered on sale of assets. When you sell the asset to the third parties, what you get is bank or cash account debit to realization account. Normally, when you sell the assets, we write that is bank or cash account debit to asset account. Now, here we cannot credit the asset account because the asset account is already closed by transferring to realization account. So that is why instead of crediting the asset account, we credit the realization account. Okay? If you sell the assets to the third parties for cash, under such circumstances, the entry to be made is by cash or bank account, okay, in the realization account on credit side and bank account debit side. Suppose if any partner take over the asset or assets, then instead of debiting bank or cash account, you have to debit the partner's capital account and credit the realization account. So when you post this journal entry in the realization account, in realization account we write on the credit side as by bank or cash, and you have to show which asset, how much it has realized. Individually you have to show one by one under this bank or cash account. In the same way, if any partner take over any asset, you just write by partner's capital account and write the amount that agreed value of the asset taken over should be written in the amount column. Suppose if a partner takes more than one asset, and those assets are to be listed below the partner's capital account. For example, furniture taken over, stock taken over and all, the total value you can write it directly in the amount column. So this is how you have to make the entry for the assets realized. Then coming to the fourth step, that is settlement of external liabilities, whether they are recorded or unrecorded. Once you dispose of all the assets, you will get the money. As and when you get the money, you can start making the payment. So first we are going to make the outside liabilities. Okay. So when you make the payment towards the outside liabilities or external liabilities, we are going to show this entry on the debit side of realization account as to bank or to cash account. So here, suppose if question is silent about the settlement of any liability, then it should be assumed that those liabilities are paid at their book values. Okay. Now sometime a particular partner or partners may agree to pay or discharge the liabilities on behalf of the firm. Like how partners take over the assets, like that they may agree to pay the liabilities. Suppose if any partner or partners agrees to pay the liabilities, then realization account is to be debited with what? To partners capital account. Okay. The journal entry for making the payment of external liabilities, realization account debit to bank or cash account. When you post it, it comes in the realization account on debit side as to bank account or cash account. If you are preparing bank account, you have to write bank account. If you are preparing cash account, you have to write cash account. Whether to prepare bank account or cash account, it depends upon the information given in the problem. Then suppose if partners agree to discharge any external liabilities, whether it is recorded or unrecorded, under such circumstances, the journal entry is realization account debit to partners capital account. When you post it, it comes in the realization account on debit side as to partners capital account, and you have to show the details of liability paid by the partners. Then the fifth step is you have to make entry for the payment of realization expenses. To realize assets, sometime it becomes necessary for us to incur some expenses. Like sometime if you are giving the advertisement, you have to spend the money for that, for giving advertisement. Sometime you may sell the asset to brokers or agents, they will charge you commission. All those expenses are called realization expenses. If the firm pays the realization expenses, then the entry for that is realization account debit to bank or cash accounts. So, you have to write it in the realization account on debit side as to bank or to cash accounts. Or if partners pay the realization expenses on behalf of the firm, under such circumstances, the entry to be passed is realization account debit to partners capital accounts. So, this is what you have to do as far as the payment of realization expenses is concerned. After doing all this, the last step is you have to see what is the overall result of this realization account, whether it has resulted in profit or loss. So, for that purpose you have to balance the realization account. You have to see if the credit side total is greater than the debit side total, the difference is called profit on realization. On the other hand, if the debit side total is more than the credit side total, the difference is called loss on realization. This is in aggregate, it is in totality, not asset wise or not liability wise, it is in total. Suppose if there is whether it is a profit or loss, that profit or loss is to be distributed among the partners in their profit sharing ratio. If it is a profit, you have to write it on the debit side of partners capital in the realization account as to partners capital account, and you have to show the distribution of profit on realization. On the other hand, if the debit side total is greater than credit side total, the difference should be written as by partners capital account, then you have to show the share of partner A, partner B, like that. So, this is how the realization account is to be prepared. So, with this, the first step in the dissolution process comes to an end. We have paid all the external liabilities. Now, what is left is only the internal liabilities. So, that you have to settle with the help of the other account called partners capital accounts. Once we pay all the external liabilities, now you have to start paying for the partners capital accounts. Now, before settling the partners, whatever the balance is there, that balance is to be transferred to partners capital account. You know, on the debits, on the asset side of balance sheet, sometime you may find like partners capital balance, accumulated profit, or some fictitious assets like preliminary expenses, advertisement fund and all those items are to be transferred to the debit side of partners capital account, okay, and that should be distributed in the old ratio. Then coming to the capital balance, on the liability side you will find partners capital balance, sometime you will find reserves, various types of reserves like general reserve, investment fluctuation reserve, workmen compensation reserve, contingency reserve, all these reserves will be there. So, whether reserve or accumulated profit, sometime you find profit and loss account balance on the liability side of the balance sheet. So, all those items are to be transferred to partners capital account on the credit side. The journal entry for that is general reserve or other reserve account debit, profit and loss account debit to partners capital account. When you post it, it comes in the partners capital account on credit side. If it is accumulated loss, you will find accumulated loss on the liability side. So, that loss should be distributed in the old ratio. The entry for that is partners capital account debit to profit and loss account, and when you post it, it comes in the partners capital account on the debit side. So, you have to write as to profit and loss account. So, these are the opening balances you have transferred, and after that, as I already told you, sometime a partners may take over assets or liabilities. If any partner take over any asset or assets, the first effect is shown in the balance in the realization accounts, and the second effect is shown in the partners capital account. Whatever you write in the realization account on credit side as by partners capital account, that comes on the debit side, okay, and whatever is written on the debit side, it goes on the credit side. So, suppose if asset is taken over, you have to debit the concerned partners capital account and credit the realization account, that is partners capital account debit to realization account, and when you post it, comes in the partners capital account on debit side as to realization account. If liabilities are taken over or if any partner have paid the realization expenses, those entries comes on the credit side of partners capital account, okay. The journal entry for that is realization account debit to concerned partners capital account. The first effect is shown in the realization account on debit side, and the second effect is in partners capital account on the credit side. So, this is how you have to make the adjustment for the assets or liability taken over by the partner. Once you finish posting this transfer of assets and transfer of liability taken over by the partner, then whatever the profit or loss is there on realization account, that also has to be transferred. Suppose if there is a profit, when you transfer the profit, the journal entry is realization account debit to partners capital account. When you post it, it comes in the partners capital account on credit side as by realization account. On the other hand, if there is a loss on realization, so that comes in the partners capital account on debit side as to realization account. So, this is for transfer of profit or loss on realization. So, first of all, what we do in partners capital account, the opening balance of the partner is transferred. If it is a credit balance, that is if capital balance is shown in the balance sheet liability side, it goes to the partners capital account on credit side as by balance brought down. Sometime you may find debit balance. If it is a debit balance, you will find partner capital balance on the asset side of the balance sheet. If it is on the asset side of the balance sheet, that should be shown in the partners capital account on debit side as to balance brought down. Then if there are any fictitious assets like advertisement fund or any deferred expenditure, that also should be distributed, and that comes in the partners capital account on debit side. Then if there is any reserve and all, it goes to the credit side. Then transfer of asset taken over, liabilities taken over. Then finally you have to transfer the profit or loss on realization. So, when you transfer all these things, we will come to know what is the position of the partners capital account, whether there is a surplus or deficit. Suppose if the partners capital account credit balance is more, then that becomes a surplus, that difference amount you have to pay to the partner. On the other end, if the debit side total is more than the credit side, then it is a deficit. If it is deficit, the partner has to bring in the amount. So, if the capital account of a partner shows debit balance, in such a case, partner is required to bring cash to meet deficiency of his capital. The entry passed for this is cash or bank account debit to partner's capital account. If capital account shows credit balance Then the entry passed is partner's capital account debit to cash or bank account. That is, the excess amount in the capital account is to be paid in cash. If it is a deficit amount, that amount should be, you should ask the partners to bring in. So this is how you have to do the final settlements with the partners. Then the last account what we are going to prepare is bank or cash account. Now the first step in the preparation of bank or cash account is transfer of bank or cash balance from the balance sheet. As you know, cash or bank balance appears in the balance sheet on asset side. That balance should be shown in the bank or cash account as to balance brought down. So this is the transfer of bank or cash balance from the balance sheet to your bank or cash account. Second step is assets realized to be debited to bank or cash account. Whatever the amount is recovered on sale of assets are to be debited to your bank or cash account. Then third step is payment of liabilities, that is external liabilities, realization expenses and partners loans are to be credited to bank or cash account. This is the payment entry, so outflow of cash. So all the payments goes to the credit side of your bank or cash account. Suppose if any partner is having a deficit amount, when a partner bring in the cash, that should be shown in the bank or cash account on the debit side, okay, as to partner's capital account. Then in case if any partner is having the surplus amount or excess amount, that amount is to be paid in cash. When you make the payment to the partners in their final settlement, that should be shown in the cash or bank account on the credit side. Once you complete the posting of all these entries, your cash or bank account will close. With that, the books of the firm will stand closed.
Prudent Scholars, powered by Lupin Pharmaceuticals.
अब आपकी सुरक्षा आपके हाथों में। ल्यूपी सेफ हैंड सैनिटाइजर, आपका और चेन्नई सुपर किंग्स का फर्स्ट लाइन ऑफ डिफेंस। अब आपकी सुरक्षा आपके हाथों में। ल्यूपी सेफ हैंड सैनिटाइजर, आपका और चेन्नई सुपर किंग्स का फर्स्ट लाइन ऑफ डिफेंस। अब आपकी सुरक्षा आपके हाथों में। ल्यूपी सेफ हैंड सैनिटाइजर, आपका और चेन्नई सुपर किंग्स का फर्स्ट लाइन ऑफ डिफेंस।